Welcome to our channel. Today, we're diving into the world of finance to explore a fascinating topic, treasury shares. Whether you're a finance student, an investor, or just curious about how companies manage their stock, this video is for you. So, let's get started. First things first, what exactly are treasury shares? Treasury shares, also known as treasury stock, refer to the portion of a company's shares that were issued and subsequently reacquired by the company. These shares are not considered outstanding and do not have voting rights or pay dividends. Think of them as shares that the company holds in its own treasury. But how do companies end up with these treasury shares? Companies can acquire treasury shares through buybacks. This is the most common method. A company may decide to repurchase its own shares from the open market. Forfeiture. Shares may be forfeited by shareholders, for example, due to failure to meet certain conditions. Donation. Occasionally, shareholders might donate shares back to the company. Now, you might be wondering, why would a company buy back its own shares? There are several strategic reasons for this. First, increase share value. By reducing the number of shares outstanding, the company can increase the value of the remaining shares. Second, improve financial ratios. Share buybacks can improve metrics like earnings per share, or EPS, and return on equity, or ROE. Third, utilize excess cash. Companies with excess cash might prefer to buy back shares rather than invest in new projects or pay dividends. Fourth, prevent takeovers. Reducing the number of shares on the market can help protect against hostile takeovers. Let's take a closer look at how treasury shares are accounted for on the company's balance sheet. When a company buys back its shares, the cost of those shares is recorded in a contra-equity account called treasury stock, which reduces total shareholders' equity. It's important to note that treasury shares do not carry voting rights or earn dividends while they are held by the company. What about the impact on shareholders? For existing shareholders, buybacks can be beneficial as they typically lead to an increase in the value of their shares. However, it's also crucial to be aware that buybacks can be a signal of a lack of profitable investment opportunities, which might not always be a positive sign. Can companies reissue treasury shares? Yes, they can. Companies can reissue treasury shares in the future for various purposes, such as, first, raising capital by selling the shares back to the market. Second, employee compensation, using shares for stock options or other employee benefit plans. Third, mergers and acquisitions, as part of the payment in acquiring other companies. In summary, treasury shares are a flexible tool that companies can use for various strategic purposes, from managing their capital structure to rewarding employees. We hope this video has helped you understand the concept of treasury shares and why they're important in corporate finance. If you enjoyed this video, don't forget to like, subscribe, and hit the notification bell for more financial insights. Thanks for watching.